All right, on a day when executive pay is the main topic of conversation, our next guest says we are still in the sweet spot for the markets and we can expect to grind higher. Joseph Quinlan is chief market strategist of U.S. Trust Bank of America, Bank of America, I should say, private wealth management, that unit. Joe joins us now from his offices here in New York. And let me first get your reaction to the executive pay, the new rules coming from not only Ken Feinberg, but also the advisory coming from the Fed. Is this really the position the government should be in here?
Well, Matt, it's a good question. I mean, I always read the book, The Commanding Heights, and it's about Margaret Thatcher and Ronald Reagan from the private sector driving growth. I think we're looking at more of a mixed economy here, public sector, private sector working together, hopefully to straighten out some of these issues that have caused a lot of problems financially and in the real economy. So hopefully whatever we're doing is going to be best for the economy and for investors.
Hopefully, but it doesn't sound like you're convinced, Joe.
Well, you know, I'm a free market type of person. I believe in globalization. I've always been worried about protectionism here in the United States and overseas. And just the visible hand of the government is something that we watch very carefully when it comes to impacting investors' portfolios.
You actually wrote in the Financial Times, you've got a column, opinion piece, The Nightmare of Control. I mean, you're really worried about how far the government's going to be involved here.
Well, Carol, let me say, that wasn't my headline, but I'll take ownership of the text. Yes, I am, definitely, in the sense that when you look at various industries, protectionism, and so forth, that I remember, a student in the 1970s, very sluggish economy, a lot of regulation that just slowed down the speed limit of the U.S. economy. So we put that high as a risk that we're watching as we go into 2010 and beyond.
Are you concerned about, or can you play on the bifurcation of banks here? I mean, some are under the control of Ken Feinberg. Some got money, did well, got out, gave it back. Are some going to do better than others here? Are there two classes of banks?
Oh, yeah, man, I think definitely. I think now when you look at the banks or healthcare, insurance, automobiles, as you have to be very selective as an investor. The sector picks, the subsector stock picking is going to be much more important here. And I think in this environment with more government involvement, absolutely. The stock picking, subsector selection is huge.
Nonetheless, you are optimistic for the global recovery. You're optimistic for the U.S. recovery, especially in that. Why?
Well, I just think, we've got a global V-shaped recovery. All the stimulus, fiscal stimulus, monetary stimulus around the world is working. U.S. companies are very productive. We're going to start to see the top-line growth. Earnings are better than expected. The weak dollar is helping exports. So I think we go higher here, led particularly by the U.S. large-cap multinationals.
Let me ask you, though, Joe, because there's been some talk coming out of China. The chairman of China Merchants Bank this week saying it's urgent for the central bank to tighten policy to avert asset price bubbles. So we're starting to hear that potentially maybe China could start to cut back on the stimulus. How problematic would that be for the global economy?
Well, Carol, I don't think it would impact the U.S. that much or the developed markets, but it would impact the commodity producers, a lot of the developing Asia economies, and these markets that have done fabulously well here. So we're recommending to a lot of our clients, if you made some money in the emerging markets, commodity producers, off to play on China, take some profits. Take some profits, book them here, put it to work other places. I don't think any slowdown in China, they'll kind of pull back a little bit here. It's not going to derail the global recovery we're talking about.
You do think, though, that the weaker dollar is going to help U.S. multinationals here. Is it a good thing, though, long term? Or are you not concerned about a weak dollar long term?
Matt, as long as it's orderly, I'm not worried about the dollar, collapsing or not being the world's reserve currency. What I like about the dollar, weak dollar, long term is simply this: it's going to force Germany and China, I should say, the surplus countries become less export driven and more consumption oriented, because we have to do the opposite. We have to promote exports and curtail consumption. So rebalancing is hugely important when it comes to the dollar and vice versa.
All right. Hey, Joe, thanks so much for joining us. Joseph Quinlan there with the U.S. Trust Bank of America Wealth Management.